Goldbroker.com own real physical gold and silver bars stored outside of the banking system.
My name is Dan Popescu, and on behalf of goldbrokers.com, I'll be speaking today with Ronald-Peter Stöferle. He's managing partner and investment manager at Incrementum AG. He studied business administration and finance at the Vienna University and the University of Illinois. Ron is a charter market technician and a certified financial technician. In 2006, he joined Vienna-based Erste Group, covering international equities, especially Asia, and he also began writing reports on gold. His 6 benchmark reports called In Gold We Trust drew international coverage on CNBC, Bloomberg, the Wall Street Journal, and the Financial Times. He was awarded second most accurate gold analyst by Bloomberg in 2011. In 2009, he began writing reports also on crude oil. Ronald managed 2 gold mining baskets as well as 1 silver mining basket for Erste Group. Hello, Ronnie.
Hi, Dan. Thanks for having me.
It's a pleasure. Ronnie, first of all, I want to mention that the report that I've just mentioned, it's the 6th one that you did this year?
8th one. 8.
8?
Yeah.
Okay. So that was not updated. Okay. It's a wonderful report that I've been following from the beginning. We'll have a link for people who want to go over because we'll be talking about it. It's a very complete report about gold. I haven't seen such a report for a long time that covers gold from every possible angle and exceptional charts. You also just finished a book. Can you tell us a few words about it? I think it's an Austrian school.
Yeah, I'm not only from Austria, but I also adhere to the Austrian School of Economics because I think the Austrian school doesn't only ask the right questions, also provides the right answers. And therefore, we wrote a book about Austrian investing, how to implement the thoughts of the Austrian School of Economics in investments, and I think it's quite interesting. It's really a big success in the German-speaking world. We're already working on the English translation, and we hope that it will be out by fall or before Christmas. I hope so.
Can you explain a little bit for the general public what's the relation? There is a very strong relation between the Austrian school and gold. I think gold is an important part. How would you explain the association between the Austrian school and gold?
I would say that not everybody who adheres to the Austrian School of Economics is a gold bug, but I think I don't know, 80 to 90% understand that gold is a monetary asset that during history, during hundreds and thousands of years, within a trial and error process, the market and the market participants found out that not cigarettes, not paper, not seashells or goat skin are the perfect money. So, but that it's gold and to a certain extent silver, and therefore, I think from my point of view, the one of the major advantages that you have when you follow the Austrian School of Economics is that you're actually thinking about our monetary system, and that's what Keynesian economics obviously do not really do. And I think at the moment we're not in a financial crisis or in an economic crisis. I think we're in a crisis of our monetary system, and therefore you have to stand the roots of our problems to find solutions. And I think gold is obviously not the only solution, but it's a major part of the solution for this systemic crisis.
You mentioned you start actually the report by talking about monetary tectonics. Could you explain to us what exactly you mean by monetary tectonics? I think it's a relation between inflation and deflation.
Exactly. From my point of view, if we would see an Austrian approach, which would be laissez-faire, do nothing and let the system clean itself, it would be a tough time, but in, I don't know, 1, 2, 3 years, we would be better off, definitely. We will start from a lower level, but from a very healthy base. Now, the fact that this would be highly deflationary, that a lot of banks would go bust, that lots of companies that could not exist if interest rates would be at a normal or natural level. This also means that we would see massive unemployment, we would see a massive recession. But as I've said, it would be that the system would be much healthier afterwards. So the politicians and central bankers regarding deflation as the nemesis. It's something that they have to avoid. So there's this natural deflation that we're seeing at the moment, and on the other hand, there's this central bank induced inflation and there's lots of pressure building up. And I think at the moment it seems that the surface is still quite stable, but underneath the surface there's so much pressure building up. And from my point of view, and there are a number of reasons for that, central bankers and politicians will do whatever it takes to avoid this natural inflation. And I think, I'm not sure if we're going to see hyperinflation, but I think some sort of a highly stagflationary environment is very, very likely.
Mark Faber was actually, I think he was interviewed a few days ago, and he was mentioning that one additional dollar of debt produced only about 10 cents of growth, economic growth. So it doesn't seem to work what the central bankers are trying to do, and use debt to get us out of trouble. It doesn't seem to work this time.
No, the marginal utility of debt is decreasing constantly, and we are in what we call the Keynesian endgame, and we can observe this endgame already in Japan. I mean, they've got 240% debt to GDP. The JGBs, the Japanese government bonds, are at, I think, 55 basis points for the 10-year bonds, which is ridiculously low. And we all know if interest rates would rise only a little bit, Japan would be bankrupt. So I think some sort of a Japanese scenario is kind of likely, especially for Europe. That would be probably would buy us some time, but we also have to admit that the longer we avoid this natural cleansing of the system, the tougher it will get afterwards. And I think this muddling through approach, where our politicians are very experienced in that, and it's the completely wrong strategy. But due to the political situation, I'm absolutely certain that they will continue muddling through, and we're already seeing that financial repression is getting worse and worse. I mean, now recently in Spain we have seen that they're charging for bank deposits. It's only 0.003%, I think. But that's just the beginning, and who would have thought that this would happen a few years ago? So we should expect the unexpected, and I think when the shit hits the fan, politicians become very innovative when it comes to financial repression measures.
Yeah, actually, this morning I think I was reading something that in the United States they are passing laws to restrict people from taking money out of their account. So they seem to prepare for some kind of confiscation of assets in case of a crisis, not only in Europe but in the United States.
I mean, for our highly fractional reserve banking system, I mean, in Europe, the reserve requirement is only 1%. So if 2 out of 100 people would go to the bank and say, okay, I want my money, the bank would basically bust. So yeah, politicians have to avoid a bank run, and if people would understand our monetary system, yeah, there would be a revolution tomorrow, like I think Henry Ford said that. So I think this sentiment that we're seeing at the moment, the crisis was yesterday. I think that this will change dramatically going forward. And with the geopolitical situation at the moment, I really fear that the second half of 2014 will be extremely volatile and turbulent.
There seems to be a lot of geopolitical events, but they don't seem to affect, for the moment, gold. But you have different pockets in different regions. You have Gaza, you have Ukraine, you had some fighting between China and Vietnam in Asia, but none of those events for the moment has triggered gold. You mentioned in your report about a resemblance to the 70s. Could we see the same thing, an explosion like this period right now, this small bear market being just a transitory a correction within a big move up, and will be moving once we break out of this consolidation, there will be a kind of a parabolic move, I think you mentioned, like it was in the 70s. You see the same
I think that first of all, geopolitical events will only play for the shorter term a role for the price of gold. I don't think that geopolitical events really are a game changer for the big trend in gold. The most important driver for gold is inflation. And we have seen that in the 70s as well. I'm drawing some comparisons in my report. From 1974 to 1976, we have actually seen disinflation. Inflation numbers were still pretty high. They were going down from roughly 10% down to 5%. So one would say 5% inflation, that's still a very high number. But we have seen disinflation, so decreasing inflation rates. And I did a number of quantitative analysis, and the result is clear. Disinflation is by far the worst environment for gold. Now, what we have seen since 2011 is exactly the same. We have seen disinflation. On a year-on-year basis in 2011, the CPI was roughly 4.3%. And it came down significantly until 2014. And now what we're seeing is that it's kind of bottoming. And at the beginning of the year, we made a big chart book on inflation versus deflation. We said, even though the consensus is scared of deflation at the moment, from our point of view, inflation will be the big topic going forward. And I think that was a right call. We're already seeing it. Inflation numbers are running higher in the US, even though Janet Yellen says it's only noise. The Billion Prices Project, which is a very reliable indicator for CPI and also for PCE, is also leading higher. So I think the market is already telling us we will see rising inflation. And, that's basically what politicians and central bankers want. If you compare it to 1980, when Paul Volcker kind of killed the last big bull market in gold, he said, my job is to kill inflation, and that's what he did. But nowadays, central bankers say, okay, deflation is a big scare. We have to create inflation. If it's a bit more inflation, we can we can time it, and just for a couple of years. And I think this is the major problem going forward. I think politicians and central bankers, they do not understand the dynamics of inflation. They think they can, time it here, some monetary stimulus, and then the result will be a bit more growth and less unemployment. But it's not like that. So I'm highly skeptical to all those monetary interventions that we're seeing.
Oil played a big role in the 70s as a trigger. Could oil be the same this time around, or is oil not as much as an issue for inflation? Other ingredients could create that inflation. Do you see the same role for
two important things? There was, August 1971, end of Bretton Woods. At the next OPEC meeting, this is something that not so many people know. At the next OPEC meeting, the members of the OPEC said, due to the new monetary regime, we have to reconsider the price formation of oil. So also here, the monetary regime is crucial for the price of oil. And I'm drawing also some long-term comparisons in my report, charting the dollar priced in oil, the dollar priced in gold, steep downtrend, and the price of oil in measured in gold, and it's still volatile, but it's kind of stable over the long term. So I think at the moment, with all those geopolitical threats that we're seeing, I think the upside is far bigger when it comes to oil. We should not forget that the price of oil held up pretty well. It was above $100 at the beginning of the year, when we didn't have any Ukraine crisis, for example, when everybody was talking about fracking, and that fracking is the big thing, and that it will solve all our energy problems. But the price of oil was still above $100, so perhaps there's a bit too much confidence priced in. So to make a long story short, I think at the moment oil is a very interesting trade.
John Williams from Shadow Stats talks about a run on the dollar. Now, I witnessed it in the 70s when I traveled to Europe and got caught with American Express travel checks, and nobody wanted it. A month earlier, they all wanted dollars, and a month later, nobody wanted to see one. And Jim Rickards, in his book, quotes somebody, a lady who was in Rome in the same situation, having problems to pay the hotel bill with US dollars. John Williams mentions that he sees hyperinflation because of a run on the dollar. Do you see a run on the dollar triggering something like that, the hyperinflation?
I don't think so. People are talking about the end of the dollar for so many years now, and we should not forget that they still got by far the biggest and most powerful military. I mean, we shouldn't forget that. And on the other hand, I would say, of course, we're seeing some sort of big changes in the currency landscape. And of course, we have seen Russia and China making this huge gas deal that they've been negotiating 20 years for. We're seeing many tiny puzzle pieces. But I think the change to a multi-currency system, that's a very long-term thing. That's not going to happen on one day, and I don't think that people will lose trust in the dollar just on one day, and then there will be hyperinflation because of because the US dollar will be smashed. I don't think it's going to happen like that. But of course, I mean, the fiscal situation in the US is not very good. But I don't think, honestly, that the situation in the US is so much worse than in Europe, for example, or in China. I mean, having a look at the central bank balance sheet, I mean, China is the inflation world champion, I would say. So compared to the People's Bank of China, the Federal Reserve looks almost hawkish. So I tend to disagree with this view that the dollar will collapse.
Okay. There was an article in the Financial Times, very interesting, that I found, and I think it was last week, about a gold-backed system of trade starting up, where they use deposits of gold either in Singapore or in other places, and do the transaction leaving the dollar out of it. With what happened to BNP, could that trigger, for example, a panic of companies or countries to find ways and use another system? And it seems that the only one that it has trust is gold right now. And even if doing transactions in gold, it's not as practical, but if you use it as in a deposit in Singapore, for example, or in Switzerland, and you just exchange deposits of gold from one client to another, the same thing that the central banks do, could that trigger an event, for example, like BNP, which is carrying quite a lot of people worldwide, that it could happen to them, the Russians or the Chinese, that the US could freeze their assets? So even if it's more expensive, even if the dollar offers advantages, we better go into something else, and gold seems to be the only alternative. The Financial Times seems to indicate that
I honestly
something
haven't
is moving
read this
towards
article.
that.
I think there's a number of things happening. First of all, we have to say that the mainstream is still highly critical when it comes to gold, especially after last year. I mean, I think in the gold scene we are seeing this confirmation bias quite often. So people who are into gold, they mostly read the same web pages. I think we should not forget that, I don't know, 99 or 95% of the people still regard gold as something, very volatile, and it's useless, and it's just lying around, and it's not productive, and so on. That's still what very, very many people think. So therefore, I'm not sure if such a system will succeed going forward. But we can see that lots of trades are settled on a euro basis, also on a Chinese yuan basis. And I also think that the cryptocurrencies will have a great future. I've met a couple of very, very bright people who develop not the second, but already the third generation of cryptocurrencies. So Bitcoin was the beginning. Now there are like 200 or 300 other cryptocurrencies, and they're already working on the next generation. There's so much going on at the moment. I think that gold, within a period of change, people will probably go back to gold, because it in history it did a pretty good job in preserving purchasing power, and you always need, at the beginning, you need something that people trust in. However, I'm not sure, unfortunately, if there will be a gold-backed currency, because that would have also massive consequences for politicians, for example. So we'll see, but I honestly fear that something like a special drawing right will be will become much more important within the next crisis. And I think 2008, this will look like a kindergarten party in the next crash.
How do you see the CDR, the way China is playing? They haven't announced their reserves, their gold reserves, since 2009, and everybody's waiting for that to see. Everybody thinks that they must have at least 4,000 or more gold reserves. How do you see them playing it with the CDR? Is that a card that they are using in the negotiations for the CDR?
I think that looking into Chinese history, they had very high inflation, in fact hyperinflation in the end of the 40s, beginning of the 50s. So it's a bit similar like in Germany and Austria, for example. People really value gold very highly, and it's not only private people. It's also the People's Bank of China that is obviously buying much more gold than they're officially announcing. So my estimates would be that they own roughly 5,000 to 6,000 tons of gold. That's based on the import numbers. And I've been talking to Chinese officials quite often. So yeah, perhaps they will. They're also working on a kind of a gold-backed Chinese yuan. I'm not sure, but I think that the Chinese do not want to see the Chinese yuan as a reserve currency, but rather as a trade currency. And that's what they're very actively promoting at the moment. They are announcing agreements on swaps, swap agreements, bilateral swap agreements, basically on a daily basis. So there's really a lot going on. Having a look at speeches and comments by Chinese officials, politicians, but also central bankers, it seems that gold really does play a major role, and they want to see something like a special drawing right with higher with the weighting of the BRICS nations, but also with some parts in gold. We will see how it will turn out, but we have already seen recently that the BRICS they announced that they will create their own monetary fund with I think 100 billion at the beginning, which is not too much. It's not too powerful, but this also shows that there are many things happening on a global scale. However, as I've said before, and that's also a big chapter in my report, I think, or I fear that the special drawing right will become much more important, because that's basically the next stage. It's a derivative on a derivative, and I once talked to Peter Miller, and he said he explains special drawing rights, and I think that's a really good explanation. He said, money used to be I owe you gold. Then it was I owe you nothing, and special drawing rights are who owes you nothing, because nobody really knows what's International Monetary Fund and so on, but it would buy time probably, and therefore I fear, because from an Austrian point of view, we should see competition between currencies, and the special drawing right is quite the opposite. But the International Monetary Fund, I've got a slide by an official publication by the International Monetary Fund in my report, and they're clearly stating that the long-term target is a global currency, a special drawing right. That's their target, and I fear that they will succeed.
Could that happen without a big crisis? Some people say that Robert Murdell, the Nobel Prize of Economics, he says United States will never accept any change to the system because it's too much in their favor. It was tailor-made for them. So they will fight it. They will come to the negotiations kicking and screaming, and do everything possible to sabotage it or avoid any big changes from this exorbitant privilege that the dollar has. Could that mean that we might? It's not going to happen without a major crisis. Monetary crisis.
Hillary Clinton saying, "Never waste a crisis." There's so many black swans around. The system is much more fragile than in 2008. The whole connectedness between financial market participants is much more extreme than in 2008. It's even too big to fail is even worse than in 2008. On the other hand, you know, in 2008, the central banks were able to lower interest rates. They were able to create something that they named quantitative easing. But now they don't have too many bullets left. And on the other hand, countries, you know, they have implemented massive stimulus packages in 2008, 2009. Now, what should they do? Debt ratios are up by 40% since 2007. So I'm really curious to see what they will pull out of the head once the crash starts. And I mean, having a look at the junk bond index, for example, having a look at a number of technical indicators, it seems that we're not too far away from at least a major correction.
You're using an indicator, the gold-silver ratio. I found it very interesting in your report. You describe as an indicator of deflation, reflation. You call it kind of a deflation reflation ratio.
It works, and we also did a number of quantitative studies on that, and it simply works. So, as you know, gold is mostly a monetary metal, so only 10% are used in industry. On the other hand, silver is used in a number of industrial applications. So industrial demand is roughly 50%, and it's from very mostly from sectors in very early stages of the economy. So you know, copper is called Dr. Copper, but I would say it's Professor Silver. So silver normally does really good when inflation rates are rising, while gold is doing better when we've got some deflationary pressure. So calculating a simple ratio division between gold and oil, it shows you if the ratio is rising, meaning that gold outperforms silver, it's mostly a disinflationary or deflationary environment, while when it's falling, it means that it's mostly inflationary. One very important point is when you're confident on gold and you say, okay, my mid or long-term outlook is positive, have a look at the gold-silver ratio. In every big gold bull market, the gold-silver ratio is going down. So silver has to outperform gold because inflation, as I said at the beginning, is, from my point of view, the most important driver of the price of gold. And if silver outperforms gold, it shows that we're seeing rising inflation rates. And just from a practical application, at the beginning of the year, we have seen that gold did pretty well, also due to the geopolitical situation in the Ukraine. But we have seen that that silver was underperforming, and for our fund, we said, okay, we are still kind of cautious because gold is rising not because of the inflation trade, but because of geopolitics, and that's not gonna go on forever. But what we're now seeing is that the gold-silver ratio is coming down. Silver is outperforming gold. Silver is holding up very, very well at the moment, I think. The mining stocks are confirming this move, even though we're seeing a small correction at the moment. But the gold-silver ratio, it seems that it really made a turnaround. And as long as we're seeing silver outperforming gold, you can be really confident when it comes to gold, to the mining stocks, and silver, of course.
Last question that I want to ask you is about gold and silver stocks. You just started mentioning it. Could they be indicating that they've been doing very well in the last few months? Could they indicate an end of this correction?
Our fund, we had in the first half of the year, we had, I think, roughly 150 meetings with institutional clients, big pension funds, family offices, and so on. And I always keep asking them, you know, do you have a view on gold and on mining stocks. And when you mention gold, they are already kind of ridicule you. But when you mention mining stocks, you say, okay, you're a funny person. Nobody takes you seriously. And I think this makes me, from a contrarian point of view, very, very confident. The sector is fairly small, so I think the total market cap of the gold and silver stocks is roughly 300 billion US dollars. That's not too much compared to other big companies, like big blue chip companies, and that's the total market cap of all the gold and silver miners. I think they did a tremendous job in getting their costs under control. We have seen that lots of CEOs were kicked out. They cleaned their balance sheets. They had massive write-offs. So I think that the leverage is probably even bigger nowadays. And we have seen that the mining stocks are doing very, very well. Gold did very well in the first half of the year, but nobody's really talking about it and nobody is investing in it. So that's a perfect setup from my point of view. It's still a contrarian play. The market tells you that we have turned the corner, that we're probably in a new bull market. So from my point of view, it's an excellent risk reward.
Thank you, Ronnie, for your time. Again, I want to mention for people your report, excellent report. We'll put a link on for people to read through so they will understand what we talked about it. You explain it very, 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 very well. So thank again for your time and sharing your knowledge with our clients.
Thank you very much, Dan.